Good morning, ladies and gentlemen, and thank you all for being present with us today. Because of conflicting official commitments, I'm on the other side of town. Unfortunately, I don't have the gift of omnipresence, but thanks to the video technology, I can at least be with you to share some thoughts. If I could do so, I would be present to talk to you all in person. Before I go further, I should also like to add the customary disclaimer that the views I express here are my own as chairman and not necessarily those of the SEC as an institution or the other commissioners. Today, the committee will turn its focus to a challenge that I consider among the most consequential before us: how to encourage more companies, especially small and burgeoning businesses, to go public. As I mentioned at our previous meeting, one of my highest priorities as chairman is to reinvigorate an IPO pipeline that has diminished by roughly 40% since the mid-1990s. Decades of accretive rulemaking, including some at the direction of Congress, have made the path to becoming a public company narrower and the experience of remaining one encumbered with rules that can introduce more friction than benefit. Meanwhile, among companies that do go public, more and more investments tend to be concentrated within the same one or two industries. But raising capital through the public markets should not be a privilege reserved for those few unicorns. Today, companies tend not to go public, if at all, until after their Series E round in private fundraising, whereas 20 years ago, an IPO would be the equivalent of today's Series B or C. Our regulatory framework should provide companies in all stages of their growth and from all industries with opportunity for an IPO, particularly one that represents a capital raising mechanism for the company rather than a liquidity event for insiders. More than a corporate milestone, I also believe that every IPO is an invitation for workers and savers to participate in the prosperity of the next generation of American enterprise. When fewer companies extend that invitation, fewer Americans receive it. In short, the status quo has not served small businesses or the American people especially well, which means that we must set our sights higher than merely tinkering on the margins. With that goal in mind, I'm eager for the Commission to propose rules that deliver on my agenda to make IPOs great again. For proposals in the near term, I've instructed our staff to evaluate several ideas that, if proposed and ultimately adopted, could help all companies, but especially the smaller ones, in going and staying public. These ideas build on the concepts that have proven successful and aim to spread that success to more companies. For example, a regulatory IPO on-ramp that does not automatically terminate 5 years after a company becomes public may provide more certainty to smaller companies and encourage them to stay public. Additionally, the current so-called baby shelf rules for Form S-3 are unnecessarily complex and overly restrictive, making it difficult for smaller companies to raise the necessary capital quickly. Providing nearly all small companies with full access to shelf registration would allow them to tap the public markets quickly and when conditions are ideal. Finally, giving companies the option to file their regulatory reports quarterly or semi-annually affords flexibility based on their industry, business model, and investor expectations. As we pursue these efforts, today's discussion will be essential to informing them. Indeed, your perspectives, drawn from the depth of your experiences, are precisely the input that sound policymaking requires. After all, you see the capital markets as they are, rather than how they may appear from within the agency. So I encourage you all to be candid in your assessments and creative in your counsel. Our path forward and the state of the IPO market will be better for it. As always, thank you for your continued service on this committee. I hope that you all enjoyed today's meeting, and I look forward to reviewing the insights that certainly will emerge from it. Thank you all very much.
On this data from the SEC's IPO data site. If you're not familiar yet with this data set, it is publicly available on the SEC's website and goes back to 2000. You can actually download it into Excel and play with it to your heart's content. I'm just going to focus on select years. I'm not going to run through all the numbers since 2000. I'm also going to focus on corporate issuers. So these are the operating companies that are going public in a true capital raise event versus your blank check or your special acquisition companies that we all know now as SPACs. I am going to highlight some of the SPAC data because it really contributes to trends over the past 5 years or so. Okay. So starting in 2007, just before the financial crisis, there are 348 offerings. So this is inclusive of our corporate issues and our SPACs, but back then blank checks exist, but pretty negligible. The corporate issuers in 2007 raised 53 billion, right? So that's kind of our starting point for back in 2007. In the middle of the financial crisis in 2008, that drops to 60 offerings. So obviously a significant drop off in the number of offerings, as well as amount raised, corporate issuers raising 25 billion. At that low point, we then have a steady climb back through 2014. There is a high of 355 offerings in 2014, right? So we're pulling back to our 2007 pre-financial crisis levels. And the corporate issuers are raising 87 billion, which is significantly more than pre-financial crisis. At this point, SPAC activity is still low. For example, in that year when the corporate issuers raised 87 billion, SPACs raised 1.5. So really not on the market radar yet. But then starting in 2014, we see a decline that continues through 2020. And so as we engage in our discussion and think about changes that can be made, not just on the margins, but sweeping changes, we should be mindful of, rulemaking and laws that were passed before 2014. The most notable was the Jobs Act passed in 2012, and that went into effect in 2013. In our prior meetings, we talked about how the 12G changes in the Jobs Act, specifically allowing more stockholders on a cap table before you had to do public filings, may have contributed to the rise of the secondary markets, which then may have had an impact on the number of companies going public. Okay, so moving on to 2020 and 2021, we have a significant bounce back during the pandemic. We're going to see this is largely driven by SPACs. So in 2020, we have 492 offerings. So we're surpassing both our 2007 and our 2014 numbers. 79 billion raised by operating companies. So that's actually slightly below 2014. In 2021, we see over 1,000 offerings with 142 billion raised by operating companies. But the story is actually SPACs. Against those astounding numbers for operating companies, 452 of the offerings in 2021 were SPACs, and they actually outraised corporate issuers, raising 144 billion to the operating companies 142 billion. We then drop off a cliff in 2022. And I think this is really where the narrative is starting, right? We see sort of changes from the mid 90s, as Chair Atkins mentioned, but in our recent memory, 2022 is when we hit the true low point. There was only 202 operating company offerings that raised 8 billion. Sorry, 202 offerings in that year, and the operating companies only raised 8 billion. That is the lowest total for corporate issuers in this IPO data set. The SPACs also fall off a cliff, but they are continuing to outraise operating issuers with 12 billion in 2022. 2023, we come back to 169 offerings, 20 billion by corporate issuers. 2024, 246 offering with 30 billion raised by corporate issuers. So we're coming back up from that low point in 2022. Last year in 2025, we were getting back to the 2007 and 2014 levels on the number of offerings with 374, but we're not back to those levels on the amount raised by corporate issuers in these offerings. So 43 billion was raised by corporate issuers last year. Quick comparison, back in 2007, that number was 53 billion, and in 2014, it was 87 billion. The number of offerings continues to be driven by SPACs, who actually raised 27 billion last year. All right, so this year to date, just to give a sampling of where we are and if this trend from 2022 is going to continue with the number of offerings, but with the amount raised dropping, we could have some very interesting trends in 2026 if some news reports hold up. So through early April, we have 90 offerings. So if this continues, we'll be roughly on pace with last year. But corporate issuers have only raised 12 billion so far, and this was actually dominated by a few offerings. We are starting to see the rise of what some have called the mega IPOs. And again, this could accelerate greatly with the hockey stick growth in 2026 if some of the news reports come true. So for traditional IPOs, the picture since 2014, it's really mixed, especially since the pandemic, with the exception of those, 2020 and 2021 years. For those of us that were in the markets at the time, those were definitely crazy times. The number of offerings and the amount raised by corporate issuers, it has been declining. So if we think about the IPO as that capital raising event, it has been declining, with the investor dollars in those offerings mostly going to SPACs. And then we may have this trend of the mega IPOs. So, before we turn it back and go around, since I have the data set and I just threw a bunch of numbers at everyone, if there's any specific questions on the data, otherwise we can come back and refer to this as we have our discussion today.
Wendy? Okay, so I loved it. Thank you. Here? Okay. I know you have a lot of information in front of you and you might not have this at your fingertips, but in the breakdown of those numbers, do we know what small cap or what took advantage of the Jobs Act? Are those numbers available? And that's probably separate from the raises that come through the SPACs, which are huge numbers as far as I can tell. But I think our target discussion here is not just broadly how to make IPOs great again, but targeted to the smaller cap or emerging companies.
Yeah, so I don't have that drilled down data in this IPO data set. It does include mean and median, which supports that we're seeing those larger traditional IPOs coming on than we did, especially before the financial crisis. But even in that period when we were ramping up in 2014, before our decline, going into 2020. So if you look at the mean and median, you can tease some of that out. But another thing, and Chair Atkins touched upon this, the data does reflect the industries that are going public, right? So we do have the industry code. When a company goes public, they file under an industry code. There is a fair bit in the in the other category, which is if it's not in the top 14, 15 industries, this data set puts it in the other category. Otherwise, it would be overwhelming. But so we can see some trends, right? So we see, and this is for the last 2 years, is the one that's most readily available in the SEC data set. So in 2024, our top industries are business services. So that can actually, can include a fair number of small caps. And we actually just saw news of that recently of a boutique, bank going out for a public offering. So, and that's sort of the banking, financial services, and then business services. Manufacturing in 2024, we actually saw 29 IPOs. Technology, those get a lot of press. There was 30 in 2024. SPACs, 58, right? So we're seeing that. Last year, manufacturing held steady at 25 offerings. Technology held relatively steady at 44. SPAC, 144. Right. So there is an even distribution of some of those industries where there tend to be more small caps.
Any other questions about the data? Thank you, Rose. That was quite comprehensive and informative. Appreciate that. All right, so we're going to take a couple minutes for each member to be able to give some of their views. I'll go ahead and start. So when we talk about making IPOs great again, we should start by asking a simple question. Why does it matter if companies go public? Vibrant public markets are one of the great engines of American wealth creation. They allow everyday investors, not just institutions and private funds, to participate in the growth of innovative companies. They create liquidity for founders and early employees. They establish transparency, accountability, and price discovery, and they broaden ownership of the American economy. Yet over the last 2 decades, we have seen a steady decline in the number of public companies and in smaller company IPOs. More businesses are choosing to stay private longer or indefinitely, and that means more value creation is happening behind closed doors, accessible only to a narrow slice of investors. Or some companies are going public in London, Australia, or elsewhere, and this should concern all of us. If we want to reverse this trend, we need to be honest about what's driving it. And for smaller growth companies, it's not fear of competition or disclosure, it's the cost, complexity, and litigation risk of becoming public and staying public. I believe we should focus on making the public markets work again for smaller companies where the benefits outweigh the risks. To do that, first, I would support what could be called an IPO light pathway for companies of a certain size threshold. If a company has modest revenues, a smaller market capitalization, and a straightforward business model, it should not face the same regulatory architecture of a mega cap multinational. And that could mean scaled disclosure requirements, shorter registration documents, simpler executive compensation disclosure, more streamlined internal control requirements in the early years, and reduced filing burdens while the company grows into a full public company status. We already recognize that one size does not fit all through emerging growth company accommodations and smaller reporting company rules. But we should go further. If we want more small companies to enter public markets, we need a proportional system. Second, as mentioned before, I support reconsidering the cadence and the burden of reporting. Quarterly reporting has value, but many smaller issuers, it can also encourage long-term thinking and impose material costs. There is a legitimate conversation to be had around allowing some smaller issuers to move to semi-annual reporting paired with current reporting for material events. That preserves transparency while reducing unnecessary expense. And third, we need to address litigation abuse. This is one of the most underappreciated deterrents to going public. Too often, the moment a stock price drops after an earnings miss or a macro event, a lawsuit appears. Even when claims lack merit, defending them is expensive and distracting. I would like us to study systems like Canada's, where unsuccessful plaintiffs can be required to pay legal costs. The loser pays framework or some version of fee shifting for frivolous security suits would discourage weak cases filed simply to pressure settlements. Legitimate claims should absolutely proceed, but nuanced litigation should not be a part of the cost of accessing public markets. Fourth, we should improve aftermarket support for small issuers. Going public is not enough. Companies need research coverage, market making, and secondary liquidity. Too many small public companies become invisible after the offering. That hurts validation, capital access, and long-term confidence in the system. And finally, we should remember that being public should be a milestone to celebrate, not a punishment to avoid. Today, for many smaller businesses, the message is, congratulations, now prepare for years of higher legal bills, accounting costs, compliance burdens, and litigation exposure. And that is the wrong message. So America does not need fewer public companies, we need more. We need more opportunities for entrepreneurs to scale, more chances for retail investors to participate, and more pathways for innovation to reach the public markets. And with that, I will turn it to you, Rose.
So when I think about this conversation, first I start with the why, right? Why do we want to increase IPOs? Why do we want to increase the number of public companies? And how does that benefit the companies that are really within the remit of this committee, right? So this is not the companies that could go public in a mega IPO that have the funds to deal with everything that Marcia just talked about, right? So this is the companies that if they were to go public would be the small cap companies. Think forward a little bit more. Would be the small cap companies. So why do we want to increase those numbers of IPOs? Why do we want those companies public? Well, I touched upon that in one of the data points. There is capital access for these companies in the public market. It's there. So the promise is there for our small businesses if they can get there and if they can sustainably stay there. But I think it's important that we always come back to why are we doing this and is there a benefit? And if there is a benefit, what are we doing to make sure that that benefit is truly there and truly sustainable? And so one of the things is actually what Commissioner Peirce mentioned, which is education, right? Like IPO process is a very frenetic process. Like I love the duck analogy because there is a lot that goes on in a short period of time, even with timing risk and these offerings get dragged on. There's these sprint periods that happen. A lot of executives and boards are not prepared and they don't understand what's on the other side. They are focused rightly at that time on the IPO as the capital raising event and liquidity both happen at that IPO and not always looking ahead to what it means to be a public company, right? So we need education so folks understand your IPO, it is a one-time fundraising event that leads into your life as a public company. And if people are more educated as to what it means to be a public company and more prepared, you're going to have a more streamlined IPO. You're going to have a company coming out the other side to better take advantage of the public markets, to know what their options are with analyst coverage and to not be invisible as opposed to just be surprised on the other side that yeah, here's my increased cost and nobody can, see me in the markets. I think coverage is a really big issue for our smaller companies, that invisibility, because again, if the theory is you're now a public company, you have access to the public, markets and the capital in those markets, but nobody knows about you. No one sees you. You're not in an index, right? Like you don't actually have the benefit, you just have the cost of being a public company, right? So the changes are, let's get them there in a more streamlined, let's make them prepared. And then they truly do have to have access to the public markets. So I'll stop there because I really want to continue this discussion, but I want to make sure that we're focused not on those companies that could go public and for business reasons and market conditions are choosing not to, but how can we keep the benefits, the promise of the public markets for the smaller cap companies?
Awesome. Thanks, Rose. Bart?
I'll probably continue on with the same theme here. I guess for a little bit of background, the companies I typically work with are going to be at the earlier stages, sort of the Series C to Series A type of company. And for the most part, the discussions in the board meeting do not really involve any discussion of going public. The venture capital investors aren't pushing for it. The board members aren't pushing for it. That is a little bit of a change from when I started out in my career many years ago at this point. And so I think some of that is reflected in the data that Rose sort of pointed out. My suspicion is that there are a whole lot of reasons that are driving that. But for the sum total of them is that IPOs are frankly not a goal of companies in the way that they used to be. I think that does cause, or I would say that the SEC should take a deep look at what the benefits of being a public company are. So we have talked a lot about, access to capital, access to liquidity, which tend to be the main drivers. I think one aspect of that is that, frankly, there is more capital and more liquidity available in the private markets than there was a long time ago. In general, that's probably a good thing. But really driving into maybe the reasons for why that is. And then the other is, I think the reality for a small company is that some of those stated benefits of access to capital and liquidity don't pan out in reality. So if you are really at this point, a sub-billion-dollar market cap company, much less a sub-$250 million company, which is kind of the purview of our committee, the liquidity doesn't exist in the public markets. You don't have market makers, you don't have viable trading options because there's nobody there to buy the stock. I think there are a lot of reasons that go into that, that go to market makers, go to analyst coverage. We have heard previous people from various exchanges talk about some of the regulation in the exchange environment. And so I think there's a lot of fodder to look in at the exchange rules, whether or not there's ways to encourage diversity in offerings to basically make the liquidity there on not just the going public SK portion of it, but all right, great. Now that you're an actual public company, is liquidity going to be there? If you get liquidity, I think that drives some of the other advantages that we talk about, which is price discovery, which is, you'll get increased access to capital raising opportunities because with a liquid stock, there's going to be more investors that are going to be more attracted to you. So as we kind of go through this, I think those are important aspects to look at, in addition to reducing the actual compliance burden, the disclosure burden, which I do think will help, but I think it goes well beyond that. In terms of other opportunities, we've talked a lot about litigation, the risk of being litigation in a public company. I think there are ways that the SEC could look at that could actually turn that into a benefit, because at least in my practice, I am seeing increasingly more litigation in the private markets, which didn't used to be there a few years ago. And so if there are a way to tie sort of a benefit of the increased disclosure that you get in the public markets to getting a benefit of that in the litigation events, again, there's a lot that goes into that because you're crossing state and federal rules and civil procedure and everything else. But as the SEC or as the chairman has asked us to think boldly, I would say, great, to think boldly about turning litigation defense into a benefit of being public and instead of a detriment.
Great, thanks, Bart. Herbert?
Good morning. As my colleagues are speaking, I keep going back in time to what's happened with me over the past couple of months. I will say that from my background, I got an email a couple of weeks ago from an entrepreneur with the SaaS platform, and the email said, "Hey, we built an MVP, and we'd like for you to take a look at it." And it seemed bizarre because it's been a while since I've heard someone tell me that they've got an MVP in a world with AI, when you can build beyond an MVP and have a core functional product. As I listen to my colleagues, I think this AI is becoming the pre-IPO filter, just as it's the the pre-investment filter for a lot of the work that we do. And I think as we move forward, we need to make sure that we're considering the impact of artificial intelligence with these smaller cap companies who decide that they want to move forward, because it's all about structured data, repeatable systems, and real visibility into the business, not just the narrative. And with AI, you can dig a little bit deeper, go a little bit broader, and get to the real. What is the real business? Are you actually trying to? You have a business where you're trying to push your way into a market, or do you have a business that's pulling you into it? And obviously, you would want the latter. Commissioner Peirce talked about a couple of things, and when she spoke, she talked about, when you think of the IPO, which underwriters are we engaging? How much management time is diverted? What are the deal execution risks? All of these things can be answered very quickly using artificial intelligence to do most of the work. And what I believe is missing, we talk a lot about having access to capital. I don't believe it's an access problem. With the Main Street business, you can't get capital with a 400 credit score. It's just not going to happen, right? So part of our focus probably should be on readiness for capital as opposed to access. We know that there's lots of capital on the sideline, but the people who need the capital, they're not ready to engage with the capital providers and have a conversation about how they should deploy their resources. So at the end of the day, I will leave, my final thoughts will be, we should look at the scaffolding when we think of post-IPO support. What is the scaffolding that's in place to support these folks who want to go public? And is that scaffolding frictionless? All the legalese, the fees and stuff like that. How do we reduce the friction that's going to allow folks access to that scaffolding? Thank you.
Super, thank you. Vincent.
I'll be a little more philosophical. Reviewing the materials and listening to everyone's presentations. So, the United States, our capital marketplace overall, 250 years, going strong, literally the crown jewel of the global economic marketplace, and largely has led to the elevation of civilization, and will continue to do so across the world. At the same time, it's challenged with the burden of any legacy incumbent who's been a leader, which is they have kind of the institutional infrastructure administration that they're in many cases feeding, and it's feeding itself, as opposed to being able to have a kind of fresh eyes and fresh start. And as I thought about the commentary and thought about the presentations that were given as well, it almost feels a bit like we're trying to, in moments, think about recapturing the past of 2021. All right. And I would say we need to shed that concept and think more about building for the future. And so while we appreciate our legacy and clearly have a lot to leverage from that, I think we want to have a fresh eyes perspective. And it stuck with me, Chairman Atkins, in the materials leading up to it, and he kind of alluded to it a little bit too, this idea of first principles. And if we think about it from a venture standpoint, clearly our greatest innovators and builders always start with first principles. And the other concept of materiality, which clearly comes across the board in terms of how we think about, so-called protections and policy from a materiality standpoint. Again, both those ideas lead to a fresh perspective. I would push for that. And Chairman Atkins also talked about previously, what he sees now as an IPO, or I should say in the past was an IPO, is kind of today's Series C. And he sees companies kind of IPOing post Series E. So, in a sense, it goes to the questions of why, right? Why do we talk about IPOs? Why are we promoting them? And from what, from the materials and clearly just reflecting on it, clearly we want the public markets to be able to participate. Clearly there's a call and an earned right to liquidity. And then also clearly you want to fund, the rise of the private marketplace and innovation. So as we think about those things, many of those things now you can get in the private marketplace. You can build phenomenal companies. Clearly, we have a pending biggest IPO in the history of the world and in the U.S. marketplace with SpaceX upon us soon. And that's clearly that's kind of a unique case. But I would say if you look at kind of the venture marketplace and technology in general, I would say there's they're very, very common threads where essentially you have a secondary, you have a private market that you're able to raise significant amounts of capital from. So, you're funding innovation. You're funding the private marketplace. You're funding American innovation leadership and security. You're able to have liquidity events for founders and investors, and you're able to enjoy that. What you don't have is public market participation. And that's something we've talked about previously. So, and you've heard me previously. I know many people on the committee share the opinion that we need to kind of open up the private markets more so that more people can participate. Because the private marketplace has responded that we'll fund innovation and we'll allow for liquidity. The only as we think about the why, the only kind of constituency that's not able to benefit is generally the public at large, because we've talked about it before, that generally there's been kind of a condescending perspective on the public market participating in the marketplace. So I think we need to change that. So and I believe one of the articles they talked about China and the star market, and we should have an open mind and look to all and be inspired and say, what could we do better? What could we do different? Again, I would go back to first principles of materiality to lead kind of the thinking on that. But I would say that, you have another nation, a competitive nation, clearly, that's doing something a little different and has seen some results. So what I would say is we take a fresh perspective. And I know a lot of times when we talk about things, we talk about it from a specific rulemaking standpoint. How do we amend this rule or that rule? And there's a lot of numbers and letters and sections that are referenced, and we go one by one. Given that it seems like there's a real appetite in our country today in government to take a really fresh and aggressive perspective, I would recommend that we look to do that, premised on first principles, premised on materiality, premised on the fact that we have a robust private marketplace, and thinking about how the public markets and the private markets can work better together so that the public investor is able to participate more. And then also clearly that, we're able to better facilitate as well private investment in innovation, American leadership, and also, liquidity for founders and investors.
Great, thank you. Jennifer.
All right. So my perspective is going to be pretty narrow and based on the practicalities of an early stage startup going public and what are some of the considerations that typically come up in that context. So as a way of background, I provide fractional general counsel and compliance services to startups and VC-backed companies and funds. So I spend a lot of time with founders and startups that are thinking about these issues and working to scale and to build their platforms. So I especially appreciated Commissioner Hurst Pierce's reference to the lead up and what kind of work happens at the pre-IPO level. And from my perspective, what I've been seeing is that, companies are struggling with the regulatory compliance and the governance infrastructure that's needed to support a scale up, and that gap starts relatively early. And we've talked about how some of the data is showing that what IPOs are becoming is that of a last resort. And from where I sit and what I've seen, that comes from the decisions that are happening at the earlier stage for a lot of these companies and startups. Most startups are operating in what I call a pre-compliance phase, and that's where governance is pretty informal. They don't really have a compliance infrastructure. Everything is pretty reactive or non-existent. And capital, when we're thinking about their capital raising strategy, it's without any long-term structuring in mind, and especially without thinking about how legal support is going to assist in that regard. So as the business scales, the structure doesn't necessarily scale. And so by the time those considerations occur, they're still catching up, and they're not ready for that discussion. And then when you layer that with some of the costs that come with IPO, and the liquidity concerns, and then just the lack of research coverage, I think the incentive for them becomes a little less likely. And given that their access to the private market is more accessible, they tend to stay private longer. And so I think for a lot of smaller companies, especially early stage startups and funds that are starting to think about these issues, they're pretty rational. And if compliance is costly, they're going to postpone even thinking about going public. And if private capital is more readily available to them, they're going to rely on those things. So for policy recommendations, I think one of the things that we can continue to do is to look at how the frameworks that we currently have set in place, like Regulation CF and the accredited investor rules, can continue to evolve to increase participation for startups and early stage founders. I also think there is an opportunity to broaden the participation beyond how we have defined accredited investor to traditional wealth thresholds to something a little bit more realistic. And then also, I think we've talked a little bit about pathways to the public markets. And so not every startup and company is the same, and they need support at various stages. And so I think there might have been some discussion in the materials about a tiered approach, whether that's in the reporting or the compliance, or how those structures are listed. And so in essence, I think creating some flexible systems that recognize the challenges, especially with regulatory compliance and access to high quality legal services that are needed to be able to go public, is a real concern for early stage startups. And as they are considering these things, they're trying to make rational decisions. And having education and access to flexibility and those and ways to get around some of those hurdles would probably help to increase the incentive for going public.
Thank you. All right, Laura.
Thank you, Marcia. So I feel a little bit like I'm piling on here to some of the early comments, but I agree with Chairman Atkins' points that he made in the preparatory document regarding the need for litigation reform, which was also brought up by Marcia Daywood, and really around the costs and the risks to public companies of shareholder lawsuits. So, one deterrent to going public and remaining public arises from, there's really a confluence of events that's occurred in the last 10, 15 years, where there are social networks and modern internet platforms that allow information to move very quickly. There are automated trading platforms that will respond to that information and move the share price substantially. And then almost pretty reliably, there can be follow-on shareholder lawsuits in response to a drop in share price that was triggered by automated trading and false information. So when you have that combination of events, inaccurate or incomplete or false information that goes into the marketplace can do real damage to companies, and probably more important, to their shareholders regular shareholders who invested in the company based on the value story.
So companies should comply with regulatory requirements around truthful and uniform disclosure. I absolutely support that. Public companies must and should communicate responsibly and truthfully with the markets. But currently, outside parties do not have the same requirements. Importantly, First Amendment rights allow people to say whatever they wish to say. And I'm a strong defender of First Amendment rights. However, as someone once said, First Amendment rights do not extend to falsely shouting fire in a crowded theater. When inaccurate information combines with rapid dissemination that destroys corporate value and triggers shareholder lawsuits, this meaningfully adds to the management burdens and deters companies from going and staying public. Short sellers can disseminate inaccurate narratives that destroy corporate value while providing for their own enrichment. And perhaps most importantly, this hurts regular shareholders who invested in the companies, as I said, based on the actual value story. So again, First Amendment rights are indispensable and they should be protected, full stop. But we should consider whether litigation reform might be enacted in order to reduce the damage to corporate and shareholder value that's wrought by false narratives that are promulgated by self-interested actors in the current high technology world that we live in. Thank you.
Great, thanks, Laura. Wendy?
Thank you, Marcia, and thank you everybody for comments that I mostly agree with. In particular, I think Vincent touched on aspirational, where do we want to be, not from where we have come, and answer that question, which I have not heard any data on where we intend to go. We have the historical data. Anyway, thank you for the opportunity to provide my personal perspective. My comments are informed by practicing in global public accounting networks the majority of my career, with significant focus in the public company space for smaller and early stage entities, plus my more recent experiences here, learning a tremendous amount about the private funding space, and also a significant commitment I have to independent audit standard setting, where we do spend a tremendous amount of time listening to the different players in the ecosystem, particularly investors, on what matters to them. And so we haven't really touched on that, but the members of the ecosystem are of critical import. Who they are, who they're friends with, who they talk to. And I'll get to who I believe those players are in a minute. I do have to say my remarks here today are my own and are not attributed to any of the organizations I'm affiliated with. I fully subscribe to making IPOs great again and applaud the SEC's planned actions, but they certainly can't do it alone. Where they're headed with scaling and simplifying disclosures, and that alone isn't going to have a tremendous impact. Reducing some of the burdens of going public and being a public company, I think, will have an impact. And limiting the potential for litigation, I think, is a significant area that needs to be addressed. All with the clear intention of maintaining quality and transparency and investor confidence. I strongly subscribe to one size does not fit all. There has been a tremendous focus, and I don't know who said it in the room, about I think it was Jennifer who just talked about that some of the smaller companies don't have infrastructure and perhaps are not compliance oriented. And I strongly disagree with that. I think that formal versus informal doesn't change the objective of some of these smaller companies to want to do the right thing with quality. And while there isn't, some control that you can go double check, those processes do take place. It could be in a meeting. It could be, it's just not as formal as it could be, but the objectives are appropriate. So there are plenty of opportunities right now for smaller companies to raise money. The money is available. It's pretty clear from founders that they've chosen private capital because that's what their advisors have helped them choose, perhaps. Private capital is more attractive because of the availability and the time to getting the money. With perceived lower risk and perceived lower cost, and with probably actual greater flexibility. And there's also a perception that the exit options or getting additional money is faster, or exit through M&A is just more desirable than going the public route. So I think we've spent time on compliance is time consuming and costly, and that's why private companies are choosing to stay private longer. So where do I think we should head? We have to stay focused on who's in this market and why are they making the decisions in the broader context, whether it's the founders, investors, accountants, attorneys. There's an endless number of people that play in this game. What can be done to change the mindset of some of these key players, particularly founders and their advisors, that would result in improvement in the trading and marketability of smaller entities? What incentives, because we know incentives change behavior, can be offered that will change the current behavior of these market participants? What will cause the change in the advice? Now, and I take that from my personal experience. Relationships matter. 25 years ago, when going IPO was cool for smaller companies and really a privilege and an honor, it had a lot to do with who was in the room and who was providing advice. So some of the suggestions I'll make, none of them can work alone, and none of them will instantly pivot to more IPOs. So one of my top recommendations is improve communication and education around why going and being public is beneficial in the short and long term, while not being a compliance and regulatory nightmare. This needs to be targeted towards changing the perception. Some of the perception is real, but there's a lot of what I would refer to as marketing that can be done to improve the perception. Make private capital acquisition less accommodating. Ways can be developed. Consider changes to beneficial ownership rules. Add other incentives around the current EGC format, focusing on many of the suggestions Marcia made earlier, perhaps in longer relief periods, and looking at the existing scaled requirements, focusing on one size does not fit all. Hybrid models, perhaps, private placements and public market access. This is one that comes from my personal experience: enhanced dual listing benefits. When I just think of the nightmare of being public in Canada and the US, the smaller companies and that's just one country, smaller companies are just not inclined to do that. Increase market making incentives. And also there should be incentive programs to get analyst coverage. There's a long history on why we are where we are with analysts, but there does need to be some benefit, and that has to be in dollars, to analyst coverage for the smaller companies. I know there are some in the financial markets ecosystem that believe the current state represents a paradigm shift. I don't think so. I think we just need to vision where we want to go and what the most influential changes will be to get us there, which are some structural and some communication and educational. Just for the record, I am a fan of private funding, but I am also a fan of turning around the perception of what being a public company means through some of the recommendations that have been made around the table and some that I have added. Thank you.
All right, thank you. I don't know, Robert, if you wanted to make any comments.
I just want to echo, I think one of the key routes to expanding IPOs is going to be reducing that regulatory compliance burden. Per Jennifer's point, these are not companies that have full-time compliance departments or staff. And so we're going to see a lot of managers' time taken up meeting with different councils and trying to understand themselves how to go through the process. So anything the SEC can do to reduce that regulatory compliance burden, whether it is limited disclosures for smaller companies, increased education on compliance, or some sort of hybrid servicing, I'm not sure, but I'm in favor of all of it. I think when we can drive down the time and cost of an IPO for these smaller players, we're going to see a lot more market participants. Thank you.
Thanks, Robert. Joe?
Yeah, I'll be real brief and just, FINRA sits at the intersection of where intermediaries like broker-dealers meet issuers and customers. So we're really focused on that point in the process. Intermediaries in the BD space are involved in both the public and private space, although in the private space, it's a far small fraction of the overall private marketplace. So we have a limited view into the activities that go on there. But obviously, there's capital to be raised, as folks have mentioned. As Rosie highlighted in the stats, we've seen ups and downs in the IPO and offering markets in the public space. SPACs have definitely taken up a bigger proportion of overall offerings over the last few years, and that's something that we continue to monitor. But what I wanted to highlight is that important role that the intermediaries play, and I think several of you mentioned this through not just the offering process, but in the research coverage space, secondary trading, gathering investor interest, facilitating those capital raises, and making capital commitments that help businesses grow and eventually reach that IPO space. As Wendy mentioned, my views are my own. I don't have a cool SEC disclaimer to say, but I would just add that FINRA, and I in particular, and I think generally FINRA is in favor of strong public markets. There's a strong regulatory regime around the public markets that helps protect investors, and that's a core focus that we want to make sure that investors are protected. And anything that happens in terms of growth in the private market space, making sure that the investors who are investing in that space are protected adequately in a way that's appropriate for the type of raises and the type of investors that are participating.
Great, thank you. We're going to hear from a couple of our members online, and then we'll go to our speaker, Edwin O'Connor. Erica.
Hi, thanks so much. So I'd love to just offer a little bit of perspective from the vantage point of a seed stage VC, a GP at a seed stage venture capital firm. I'm actually deploying capital and trying to engineer liquidity in today's market all the time. So 3 observations from this perspective. One is, that when we talk about encouraging more IPOs, I think it's important to really be honest about what we're competing against. So it's not just a regulatory burden on the public side, but it's also that the private capital ecosystem has essentially built a complete parallel infrastructure for funding and for liquidity. In 2015, our global secondary transactions totaled about 50 billion. And in 2025, they reached almost 5 times that at about 240 billion. So continuation vehicles, tender offers, and structured secondaries are now really providing what IPOs used to, which is liquidity for founders, employees, and early investors. Reducing public company friction is necessary, but it's not going to be enough if companies still have a fully functional alternative. Secondly, the asymmetry between public and private disclosure itself is really a very powerful incentive to stay private. A company can raise billions through 506c. They can accumulate thousands of beneficial shareholders through funds and SPVs, and they can operate at multi-hundred-billion-dollar scale with minimal disclosure by doing that. Meanwhile, a $200 million public company shoulders the full burden of a Sarbanes-Oxley compliance load. So if the committee is serious about trying to rebalance the incentives, we might want to examine the stockholder thresholders and what the stockholder thresholds, excuse me, and whether these mega private companies who are raising over $1 billion privately might face disproportionate transparency obligations. So without that, I think easing public company rules just narrows a gap that's still really pretty wide. And then thirdly, on the small cap end of the market, we might want to take a look at this. Modernizing the Sarbanes-Oxley thresholds, extending our Jobs Act on-ramp beyond 5 years. And I love the idea of reforming the securities litigation environments for smaller issuers could meaningfully change the calculation for our portfolio companies, the ones that right now are pretty much defaulting to M&A or just perpetual private status because the public path just doesn't make sense below $1 billion in revenue. So, I think we all know that reform is definitely welcome and overdue as the markets have changed extensively over the last couple of decades. And we hope that the goal will be a public market that competes on its own merits and not just a private market that's made less attractive. Great to chat with you guys about this.
Thank you, Erica. Appreciate that.
You're welcome.
George.
Yeah, thank you. So I think I share some of Erica's sentiment there. I think in my mind, a lot of this is kind of a champagne problem, right? It's not that public markets have gotten materially worse. It's that private markets have gotten a lot better in recent decades, and we should celebrate that. We should be really excited about that progress. That said, this champagne problem is still a problem, right? And I think that there's real opportunity to find ways to make public markets more attractive. And there's been a lot of conversation about the costs of going public, and I think that's true, especially some of the indirect costs like D&O insurance and other expenses. But if you look at it, the actual cost of compliance in the grand scheme of things for a multi-$100 million business isn't that large. In talking to other founders and talking to investment bankers, what I hear more is just the very harsh expectations of public markets, and the muscle of being able to forecast to the standard of public markets is very, very high, and not a muscle that private companies have had an opportunity to build. I mean, you look at stories like the Figma, this kind of really excellent IPO, one of the biggest IPOs last year, consistently hit their expectations, but still continue to lose value, right? And that is a large, sophisticated company that had all of the resources in the world to actually go out and really put forward, excellent forecasts and whatnot. That's something that a lot of smaller IPOs are not going to have the ability to do. So it's really kind of going from 0 to 100 and having this incredible burden of forecasting put upon these relatively small, relatively young companies. So I think finding creative ways to help businesses transition into an IPO, I know Marcia alluded to it, Chairman Atkins has alluded to kind of on-ramp disclosures, finding ways to ease into the IPO market, maybe even creating different guidance for smaller public companies, and finding ways to have safe harbor for financial guidance to avoid some of those legal expenses that have been discussed. But I think generally just finding ways to help businesses ease into public markets instead of it being a light switch that you go from private to fully public that quickly, because companies need time to be able to build those muscles, to be able to build into public markets.
Great. Thank you so much, George. Davian.
Hello, good morning, everyone. Sorry I couldn't be there in person. Lots of stuff going on here in Kansas City that didn't allow me to travel. A lot of great points made by my colleagues, and I wanted to just give some information from the perspective of an entrepreneur who is, seeking, some liquidation event. That's why we all start our companies, and that's why we raise funding. I think there's several things, and some people have already alluded to it, so I won't take too much time. Just a few points. So one, um, I think that, the cost is definitely an issue, especially when you're thinking about the bar to actually IPO is significantly changed, right? There used to be a point in time where it may make sense at 50 million and now makes sense at a substantially much higher number. Um, and I think as part of that, the cost is if the buy is high, if the bar is high, in regards to the numbers that you need to attain to make that happen, and then also the cost to actually make that happen is somewhat of a challenging. I think it's a deterrence to a lot of entrepreneurs. I think what was just mentioned about Figma is something that I think about as an entrepreneur. Um, you execute, you continue to execute, you continue to execute, but you don't see the market really paying forward in regards to that execution and the things that you're bringing to market. In the same context, I do think that the private markets have gotten a lot more aggressive. There's a lot more dollars. And as entrepreneurs, we think about, this is a less path, or an easier path, I should say, in regards to taking money and maybe looking at that money from a series, taking it as series B and C, and maybe looking at that IPO later on. I think what happens is by the time you get past a series D, a lot of times the entrepreneurs have already exited these businesses, and the people that are actually running the businesses are professional CEOs. So from that perspective, the entrepreneurs, and when they think about IPO, they think that there's the goal line is somewhat moving. There's an opportunity for them to actually get their liquidation event without going through some of the burdens associated with that. So I think it's great that we're looking at it and looking at ways that we can actually streamline this process. But from an entrepreneur perspective, if you started a company and you've got seed money and you've gotten to the Series A and you're having success, with the private markets coming in, you can get your liquidation event much sooner and with less challenges or the process of going through an IPO. Additionally, as there's a little bit of a, I like to call it a SPAC hangover, right? Where, based on what entrepreneurs, and again, just looking at it from the entrepreneur perspective, have seen from what's happened in the market historically, that there is some concern. So the bottom line, it's, I think as an entrepreneur, we see the goal line is moving substantially. The costs are substantial. I think entrepreneurs who get into to really innovate, they're seeing the opportunity to get out even sooner and get their liquidation event even sooner. And so they see that as a more of a short-term goal to take private money versus go through the IPO process.
Great. Thank you, Davian. Wamima.
Thanks a lot, and really appreciate all the contributions of members of the committee. I think from an entrepreneurial perspective, I co-founded a company that has gone from pre-seed to now a Series C company valued at over $1.2 billion. And we've had multiple conversations about readiness for being public. And quite frankly, I think the three things that really come to mind for me. The first one is just the cost. The cost of staying public or going public is incredibly exorbitant. So that's something that we need to visit. Number two is just the time. Talking about guidance on a quarterly basis. As entrepreneurs, as founders, what we like to focus on is to build the future. While I understand and recognize that, providing information and reporting to your investors in the most transparent way as possible is like going to the dentist and making sure you have no cavity. But there tends to be an over-index on compliance, right, and building the future. Number three is just, the legal exposure. As a founder, I haven't gone through the horror of, building a company, something good happens every day and something horrible happens every day, and you have to shoulder all that burden. No one talks about that. Your investors show up and expect you to have everything to the T, but there's so many things that we have to shoulder. But as we talk about this particular topic, I think one thing that comes to mind is American ingenuity. We're going to be 250 years old this year. And what I found is throughout the course of this conversation is, there's a saying that, we're born originals, but we die copies. We need to have, a first principle mindset. So actually look at what we are trying to accomplish in the first place, in terms of companies going public. And is the challenge for us to unleash American innovation for us to continue to be number one? Or are we just focused on creating a pipeline for companies to go public? I think that's question one we need to sort of contend with as a nation and as an agency. And then we can sort of charge on moving forward. As a founder myself, would love to live in the future. I want us to spend a lot of our time and say, look, how can we find the next Anthropics, the next OpenAIs, the next SpaceX, so and create a strong pipeline for those companies to eventually go public and make it as easy as possible for them and for founders like myself not to be scared or think about legal exposure during that process. I haven't gone through the arduous ramp of building a company. So my recommendation is not incremental. It's more or less radical in saying, let's take a first principles view. Let's take a founders-led approach and say what actually fits for this time that we find ourselves in, because incrementalism might actually be more expensive for us to maintain. I yield.
Thank you, Amima. Appreciate that. Well, this was great. Thank you to everybody for giving us your unique perspectives on the state of the IPO market. And to help build upon the conversation that we started, I'd like to introduce this morning's invited speaker. Edwin O'Connor is a partner at Goodwin Procter and co-chair of their capital markets group. He advises issuers and underwriters on a broad range of capital markets transactions across life sciences, technology, and other sectors. Edwin focuses on initial public offerings and other public listings, including de-SPAC transactions, reverse mergers, and delisting and other public and private corporate finance transactions, including equity, equity-linked debt, preferred, and structured transactions. He also advises public and private companies on a range of corporate governance, investor relations, and other corporate matters. So thank you for being here, Edwin. I'll turn it over to you.
Thank you very much. It's a pleasure to be here and really appreciate the conversation today. As I was thinking to preparing remarks for this, one of the threshold questions I had is why? Why do we want more public companies? And as I think about that, in my experience, I've worked both here in the US, I've worked overseas, I've worked with companies in Europe, Asia, and in the US across all industries. And when I go outside the US to talk to companies about accessing the US capital markets, the reason is that we have the deepest and most liquid capital markets in the world. Those are both private and public, but the public markets that we have are a real asset. And that is based upon the confidence that investors have, the transparency in our marketplace, and the trust in the system. And I think that's all due to the regulation that we currently have. And so that is an asset. The other benefit of having the most deep and liquid capital markets in the world is that it creates ecosystems for innovation. And as a result, we have developed some of the most innovative markets and industries in the world that everyone else wants to emulate. And so having these capital markets, both private and public, is a real asset. And I think when we think about the why, it's to maintain that leadership that we have in the world. And I think that's important. The other why, though, as it relates to public offerings, is investment opportunity. So if retail investors have to wait until the last round, which is getting later and later, to invest in some of our really innovative and growing companies, there may be a sense that our retail investors are missing out on those opportunities, as what used to be a Series C is no longer, what used to be an IPO is no longer is a Series C. And that could be a driving factor in that as well. And I'm not sure if that's the policy decision behind that, but that could be a factor as well. And I think there are ways to address that as well. But fundamentally, when I was thinking about how do we create more public companies. It really comes down to the conversation you all have been having today, which is there's a trade-off. There's the IPOs competition are the private market, and the private markets are fast, they're deep. Companies can raise extraordinary amounts of capital with very little documentation because it isn't required. The investors have access to management. They can do diligence. Those deals can happen very, very, very quickly. And they're repeatable. They're repeatable over time. And so, for example, I had a company come to me one time. They wanted to raise $10 or $20 million. They thought an IPO was the viable path. I said it really wasn't. You know, it's time consuming to get public. You know, we certainly could prepare the registration statement and have all the documents to make that happen. But I said, why aren't you going out to the VCs? Why aren't you going out for private capital? That'll happen faster. It'll allow you to grow sort of quietly, allow you to build the infrastructure, hit certain milestones that, if repeated, the public market would look at and say, okay, this is a company I want to invest in. And, you know, honestly, part of the issue was the cost. That is the one time where cost is a factor. If somebody wants to raise $10, $20 million, the costs associated with being a public company, they're too high. And the underwriters that will go out and take you public, it's not just the 7% spread, but the terms on which they'll do that are really onerous to a company. They're not worth it. And so I looked at a term sheet from this underwriter and I said, this really isn't your path forward. So, you know, I said, you can ask around, but I don't think this is the right way for you to raise capital. Today, what might be an appropriate number to raise capital? 75 million. Probably makes sense. Potentially 50, depends on how you want to do it. And so that's implying a $200 million market cap. So in that zone, I think the framework for an IPO works. I think we could make it easier from a regulatory and compliance perspective. I hear everyone on the litigation concern. That's real, especially outside the US. When I talk to companies outside the US who want to access their markets, they're petrified of the litigation. Companies here it's part of the process. I think they understand it. Insurance is part of the fix. Disclosure is part of the fix. But a stock drop lawsuit, that shouldn't happen. I mean, people can't anticipate the future. Now, if somebody misled investors, which led to a stock drop lawsuit, sure. But that's reasonable. But beyond that, litigation is something to be focused on, I think. So that was sort of my digest of a lot of the conversation I heard leading up to that. And I will address today some thoughts on the regulatory and compliance burden and things we could do. I will say the work that's been done with the Jobs Act and the FAST Act has been great. It has made things better for companies going public. I still think there's room there. I think there's room in some of the ongoing disclosure. I've heard the comments regarding easier or earlier access to shelf registration statement. I have thoughts on that and other ideas like that, which I'll get into. And then in terms of some of the other questions, I can go through my remarks, but then the quarterly versus semi-annual, baby shelf, estimate of management time, things like that were asked as questions. I'm happy to address those at the end, if that makes sense, or if you have questions, we can get into a conversation after that, but happy to go through that. I definitely have thoughts on those as well. But getting back to the private versus public markets, why do companies stay private? Well, the capital's there. It's easy to access. And it is repeatable. The other thing about staying private is not every company is ready to go public. Take away the compliance burden. Not every company is ready to go public. They need the most sophisticated investors to understand and take risk on their business model. That business model may or may not be proven out. That business model was likely going to be subject to lots of volatility and change. And the patience of private investors to work through and sometimes have a voice in the room to help manage the company forward through those turbulent times or those high growth times, it's patient. It doesn't require quarterly reporting, doesn't require semi-annual reporting, doesn't require annual reporting. And that capital understands the need to work through and grow. But oftentimes when we think about a company going public, we look to the public company peer group. We look to see if this private company is going to be able to meet or beat or have some solution to the public company peer group. And that often will be, what is their growth rate? What is their growth trajectory? Will they be able to come out in a growth stage, or in the life sciences companies we work in, what clinical stage of development they're in? Sometimes it's just too early. And so this discussion will not solve those problems. But oftentimes companies will stay private for another round or two because of some of the concerns around being public and readiness. And I think we could address some of that and ease some of the regulatory burdens, and also, most importantly, have more certainty on timelines. And that is probably my number one takeaway, is that if we can give companies more certainty on the timeline to be public and give them more opportunities to hit accessible market windows, I think that would be a meaningful change. And I do think as a result of that change, companies will not have to worry about being able to access market windows. And if they can access market windows more opportunistically, I think we will in fact have more public companies. One other driver here is M&A exits. So private companies are often, being public is a seminal event in a company's life cycle. It is extraordinarily exciting and gratifying to be a part of. And it's what I love about my job, is to be a part of that part in the company's life cycle. However, in an IPO, you don't sell the entire company, and it does imply a much longer road and ahead. And if founders can get liquidity through an M&A exit, they will likely take that. And so M&A is always a threat to companies going public. But I think the main threat and the main thing for consideration today is, the competition against private markets. And what is it about private markets that are more attractive? I've suggested some ideas around that. But in those cases where somebody is equivocating between private and public markets, how can we make going public better for those companies, the better choice for those companies? And so with that, I do have some thoughts on regulatory burden that would still, if considered and taken and actions taken on, I still think would be protective of investors. And getting back to core principles, that is one of the tenets of what makes this marketplace trusted by all, and has to date created, as I said, one of the deepest pools of liquidity in the world. So when I meet with a company that's looking to go public, they are usually 6 months or so before what we call the organizational meeting, which kicks off the whole thing. They say, what do we need to be doing? I say, well, you need to make sure you have your audited financial statements prepared, because that takes the most time. You need to understand your management team and your board. Are these the right people that you want to work with going forward? These are things that take time. Everything else we can get done really quickly. I don't want to undersell the burden of going public, but it is complicated. It does require putting in all sorts of new governance, communication, and other guidelines. But we can take a company public without any internal compliance function. We can serve as outside general counsel. We can manage the process in a very efficient way to the extent possible. Getting the registration statement that's required to go public together takes time, but it's about 30 or so days. It could be a lot shorter, it could be a lot longer, but it's not this insurmountable thing to get through. It could be more efficient. I've had companies where in the boom days during the pandemic, we had companies from organizational filing in measured not in a month, which is typical. It's usually 5 to 6 weeks. We had them do it in 2 or 3. So we were very efficient, and that is not the problem. But I do think the timing uncertainty. So when we tell a company from organizational meeting to ringing the bell, It's 100 days, 4 months. That's a long time. And it doesn't need to be that long. As I said, we could probably prepare a registration statement in about a month or less. So we're adding 3 months of time associated with that. Now, some of that's meeting with the investment bank's analysts, some of that's meeting with investors through the testing the waters, which is all really important. But a lot of that's back and forth on the review of the registration statement, which yields benefits. But that and then once you start to miss a quarter, you have a whole new set of financial statements. If you make an acquisition, you have delay. So this is an aircraft carrier, not a small boat. So it's a thing that needs to be navigated very carefully, and those timing constraints weigh heavily on the process. If we could shorten that so that IPO hopefuls had more certainty on timelines, that would make a meaningful difference in this process. And we've made a lot of progress in that regard to date, but I still think more is done. So my first proposal would be to eliminate or reduce further the 15-day waiting period from public filing to commencement of the roadshow. When the Jobs Act was enacted, that was 21 days. It's been shortened with the FAST Act to 15 days. The theory behind that was that transparency of the public filing and comments that may be received either through the press or others, and the disclosure would add transparency and questions to the process. I have never seen that happen. I don't know if it happens very frequently, and I think that 15 days could be eliminated entirely or reduced to something much more meaningfully short. So that would be a very meaningful, very easy, and I frankly don't think anything harmful to investors and the transparency process. So that would be the first and probably most actionable idea I would bring to you today. The second and a little bit more controversial, I would say, is tiered SEC review of registration statements. Every single registration statement for an IPO gets what we call a full review. The process is we submit the draft registration statement in most cases, or the registration statement, with the SEC. We get a call from the SEC letting us know who the examiner is going to be, and the clock starts, and we all wait 30 days for the first set of comments. Those comments come, we address those comments as a working group, we resubmit or refile the registration statement, and then a week or two later, we get another set of comments. And that iterates until there are no further comments. It's a valuable process. It picks up things from time to time, and the dialogue that we have with the staff and the companies and the banks creates better disclosure in some cases. I would suggest, though, like we have under S3 registration statements, that a decision's made as to whether a full review is warranted, whether a limited review or a no review decision could be made. There are there are registration statements where we get very, very few comments, which indicates that the quality of the registration statement was high, and the process that was put together to create the registration statement was robust enough to have good, adequate disclosure. That 30-day period, that first call we usually get from the staff to let us know who the AD is, that's helpful. I think that 30-day period, at some point within that 30-day period, there could be a determination that we're not getting a full review, but a limited review or a no review. That would be welcome. How feasible that is relative to investor protection, I'd argue it could be. I presume there are checklists that the staff go through as they're determining how to review and the types of comments to be made. But I think that could be a meaningful reduction in the overall timeline of going public. I think to the end of creating better disclosure, the staff has a history and has done in many instances Dear CFO type letters or letters regarding the quality of disclosure that they'd be looking for in IPOs. And I think more of those, coupled with a tiered review structure, so the companies who intend to put their best foot forward could put their best foot forward with the current thinking of the staff and what the staff hot button issues are, so that they could proactively address them and not need to wait to review the SEC comments. All of which, by the way, are available, and good counsel will go through the SEC comments to make sure that they're trying to address the hot topics of the day. But more transparency, more being upfront about that would create better disclosure from the get-go. And even if we can't have no review on S1s, I think it would reduce the number of comments that the staff would have to make for companies that wanted to put their best foot forward. And I think that could be a meaningful improvement. The third, this is technical, but I think worth mentioning, is exec comp generally is a lot. I think there's benefits clearly to having executive compensation disclosure. When we get into the post-IPO paradigm, I think there is room for improvement there, especially as we think about tiered disclosure based on company size. But currently, executive compensation disclosure requirements are not lined up with financial statement disclosure obligations. So once you pass year end, you're required to have the prior year's executive compensation, even though you're not required to have that in, that level of detail in your financial statements. So I would argue to harmonize executive compensation disclosure with the timing of financial statements. Again, I don't see much downside in terms of the investor protection. It does cause problems in year-end or post-year-end timelines, which really only have after December 31st until call it February 14th. And even that is a short window. You have about January to do an IPO, and sometimes this could prevent a company from going public in January, who otherwise would be able to. It should be knowable, it should be navigable, but it still trips companies up, and I don't think it adds any investor protection. And if you miss that January or potentially into early February window, you're all of a sudden requiring the next year's of audited financial statements. Your timeline shifts significantly. So this is in my view, a fairly straightforward and easy one, which could shorten timelines and help companies hit windows earlier. Communication. The Jobs Act did a fantastic job on this. Testing the waters is really important, really beneficial. I do think there's some room around improving communication around the IPO process. There are certain technical rules, 134, 135, 163A, and 169, for those of you who don't know those. The first two are rules around what press releases you can put out in connection with an offering. I think it's time to revisit those. We as counsel and companies sometimes struggle trying to fit that in. I think a more plain English read on those rules could be beneficial. 163A is a great rule. It allows a safe harbor for any communications made before an IPO to not be considered offers. That window is currently 30 days. I would suggest a shorter window, potentially concurrent with the public filing of the IPO, or 15 days prior to the IPO would be beneficial. And then the other thing I've struggled with in connection with this rule is there's a requirement that the issuer takes reasonable precautions to prevent further dissemination of the materials. And in today's world, that's really hard to do. Once the statement's out, anyone can pick it up. And so that feels like something that needs to be revisited. I don't think it adds any protection to the investors if it's clearly not a communication that was intended to prime the pump for an offering, doesn't mention the offering. It feels like it should be a clear safe harbor so long as it was made within the prescribed window before the IPO. And again, I would suggest that to be shortened from something to 15 days prior to the IPO. Another useful rule is that 169 rule, which allows regularly released factual business information to be conducted throughout an IPO, and it's not deemed to be an offer. This gets used frequently, but it also requires that the issuer has it regularly released, which makes sense. So in the fact that it shouldn't be something the first time somebody's putting out a very splashy press release or announcement, but at the same time, people get hung up often on what is regularly released, is this consistent with, and I think examining that to make sure it's more permissive and that the standard course of travel is the same. It doesn't necessarily need to be as precise as the exact sort of media outlet. I think those would all be helpful incremental changes, not as necessary as some of the others, but I think incremental changes and sort of just being more pragmatic. Another hurdle we sometimes encounter is Regulation SX 305 in terms of audited financial statements that are required for significant acquisitions. There are thresholds at 20, 40, and greater %. if that could be reevaluated in the context of an IPO, because a lot of companies are very acquisitive as they're leading up to an IPO. And if acquisitions hit these thresholds, they're further delaying their IPO timelines because audited financial statements of the acquired company and associated pro formas of the combined company are required. And an evaluation of the benefit of that would be welcome, because it comes up very frequently as a gating item, which can have several months delay in the IPO process. And one consideration there would be to extend the 75-day window, which is currently required, to something greater, or even more meaningful would be to evaluate those thresholds as it relates to IPO companies only. In terms of the regulatory reform around the IPO process, those would be my most immediate and actionable suggestions. The system isn't broken necessarily. I don't think we're going to do away with some of the investor protection elements. So for example, audited financial statements, I don't see a world in which we don't require public companies to have audited financial statements. If that's on the table, well, then we're having a different conversation than I thought we were going to be having. If having reduced disclosure, that would be competitive with private company disclosure, that would basically be an investor deck and access to diligence, which our retail investors can't have. So as it relates to the competition between private and public and making the IPO easier, those would be my proposed suggestions. As it relates to making being public company a more enticing proposition, I did hear the comments earlier and welcome them on shelf registration statements for all. I think allowing companies to access a shelf registration statement as opposed to the process of an S1 registration earlier would be a really meaningful change. I would propose that that get shortened to 6 months, not a year. That would be concurrent with the timeline of most underwriter lockups. So companies and their shareholders are subject to typical 180-day lockups. Once that lockup expires and a company is able to access the capital markets again, I think it would be very beneficial for them to be able to do so on a short form registration statement where they can own the timeline and not have to file on a S1 registration, which is again subject to review and is more difficult to deal with. As it relates to registration statements more generally, I think this would be a big improvement. I think the idea of a company registration statement or company registration without the need for a registration statement being on file is a fairly radical idea, but not a new idea. And not even requiring companies to file shelf registration statements, for example, if they're current in their periodic reportings, would be a benefit. So for example, I have WICSI companies I work with. We know we can file a registration statement at any time. We know it'll become immediately effective. It still requires auditor consent, still requires signatures of all the board of directors, and it still requires coordination. So if we wake up one day and see an offering that's available to us today, we still have some time to make all those things happen. If we could eliminate that and have it such that a company could file a prospectus, which the base registration statement and a WICSI registration statement really has not much detail. It incorporates by reference all of the 34 Act disclosure. The real disclosure is in the prospectus supplement. If we could just go to prospectus supplement, that would be meaningful. It's fairly radical. It would require a lot of work on the 33 Act and rules. So absent that, I would settle for a S3 eligibility within 6 months as opposed to 12 months. Frankly, I don't think it would change much in terms of how the staff would review those registration statements that otherwise would be on S1. Could be wrong, but that was something I think would be a meaningful change. Associated with the shelf registration statement and shelves for all and earlier access for all, I would strongly encourage revisiting WICSI eligibility. Current threshold is 700 million or 700 million. I think that could be reduced to 250 million and would open up WICSI eligibility for all and would be a benefit to all companies. When the Jobs Act came in, I think it was mentioned that threshold would be reviewed. I think it would be beneficial to review that and revisit the threshold for WIXI eligibility. And as I said, I would propose 200 million of public float. Also, as it relates to EGC status, currently EGC status, unless the company exceeds the revenue threshold, expires in 5 years. I think that should be extended to at least 10 years. If the revenue hasn't been met, the revenue threshold hasn't been met, we are working with companies that are not, by virtue of that revenue threshold, at the stage where the incremental compliance burden may be warranted, or it could be discouraging. Giving companies the comfort to know that they would retain that EGC status for not 5 years, but 10 years, unless they exceeded a certain threshold of revenue, would be a meaningful change, would help position being public from a compliance and regulatory burden as something that'd be more manageable, that you can grow into over time. So I would encourage revisiting the years under which you lose EGC status, and I think doubling could be reasonable, especially if there was no revenue associated with it that didn't otherwise exceed the filing, the filer status. Finally, and this is complex, but associated with the EGC, WIXI, and all, is the filer status paradigm. It's extraordinarily complicated. There's smaller reporting companies, there's large accelerated filers, there's emerging companies. They're all measured at different times. I've had to counsel companies through this, and with words on a piece of paper in front of me, it's challenging. I think the overlap in those standards should be revisited. I think there should be clear tiers with clear disclosure obligations, and it shouldn't be complex. I think that's eminently achievable, and it sounds like something that people are looking at today, which I applaud, because harmonization of those standards would be meaningful. And there are measurement periods where companies can be surprised. There are some helpful, are we calling them CFIs now instead of CFIs? There's a helpful CFI on this now, and as it relates to losing status, but suffice to say, this is an area where I think improvement could be made without any incremental harm to investors. So in terms of IPO regulatory compliance burden, ongoing regulatory compliance burden for public companies, those were my ideas. As it relates to the competition in private markets, which again depends on what the why is. If it's to encourage more retail investment, this is an important question to address. If it's to maintain our leadership with the deepest and most liquid capital markets in the world, less important to address, because I still think we maintain that. But I still think some of the thoughts I had heard earlier today were really interesting. Allowing funds, secondary markets are there. I am an investor that is qualified to participate in those secondary markets. I'm sure I could find out how. It's not easy. Maybe making those secondary markets more transparent and accessible would be something. You could have also ideas around, I think the venture funding of these companies is great. Maybe at a certain threshold, you could consider having funds participate that have access to retail, if you're trying to solve for retail. But I do think there's value in the private markets for the leadership that those investors bring to the table, for their patience. Those are very valuable, and not every company is ready to be public and have that public company scorecard. Even if we move to semi-annual disclosure, investors will want to know information, and some companies are not ready for that. And this is patient private capital that's accessible. And I think if the goal is to open it up to more retail-like, I think there are ways to do that, either through sidecar type investment vehicles, and greater access to individual and accredited investors. You could even consider having them more transparently traded on secondary markets. That could run into the 12G issue of the limitation on 2,000 shareholders, which was increased from 500, allowing companies to stay private longer. But that earlier investment opportunity for certain qualified investors on more liquid markets could be something to allow, if one of the whys is how do we get access to more retail type investors earlier. that could be an avenue for doing that. So with that, I think those would be my suggestions. I'm happy to take questions or thoughts. I know some of these were rather provocative in a sense, or happy to go through some of the other questions that were asked earlier and give you my thoughts.
First off, can you just explain, is it
Wixie.
Yeah, Wixie?
Sure.
Yeah, eligibility. I'm not one who
Okay.
plays in this field all the time, so.
Yeah, sorry.
Yeah.
So Wixie means well-known seasoned issuer. And a well-known seasoned issuer is an issuer that can file an immediately effective registration statement. So without being a Wixie, you need to file a registration statement, presumably in this case on Form S3, which is a short form registration statement. But that registration statement can be reviewed, and if reviewed, can take 30 plus days to go effective. With a well-known seasoned issuer, you can file a registration statement, be quote effective, and sell securities the same day. So you have certainty over the timeline of your ability to access the capital markets. Without that, you submit the registration statement, get a review, no review decision, which can take up to 5 to 10 days. And if reviewed, you've got a 30-day window ahead of you. So your access to capital is delayed. With the well-known seasoned issuer, you can do that same day and not have to plan for the potential for regulatory review. And that certainty on timeline allows companies to have more flexibility. And I think that's what we want out of this, is more flexibility, more certainty on timelines for issuers. And the purpose for more certainty on execution for timelines is windows for markets open and shut very quickly. And we've all seen it this last year. And if for whatever reason you were not ready to transact in the capital markets on a certain week, you may miss it for a month. And so having certainty on your ability to access the capital markets as a public company, it's one of the best things we've got. Is our process for accessing the capital markets is relatively quick, but it could be quicker. And so the suggestions I was making today would be to make access to those capital markets more certain, faster, and still have the shareholder protective benefits in certain areas.
So Edwin, I think it might be helpful for the committee to hear how that could impact, for example, a life sciences company that can tend to go public with, a little bit smaller, so they're not going to be Wixie eligible. And, talking about how an at the market and immediately effective offering can come together on, key business milestones for life sciences companies that right now they cannot do. They cannot, pivot on a dime if they're not a Wixie.
That's right. So life sciences is a unique industry. Most life sciences companies that go public have no revenue, and they're all based on their stage of development and their clinical promise and the therapeutic area and how disruptive their therapies are to the marketplace. And they will have what we call data readouts. And those data readouts are an update on the clinical trials that they're conducting. And a data readout is well known in advance and when it's going to come. And oftentimes we will anticipate if it's a positive data readout, there could be a financing on the back of that. So if we are working with a company that is not able to have one of these immediately effective registration statements, we need to plan. We need to plan either to have them ready through the long form S1 registration statement or a short form if they've been public for a year registration statement, but it's still subject to review unless they're a Wixie. And oftentimes they don't have that market cap to qualify as a Wixie. Let's assume they're on Form S3. We would prepare the S3 registration statement. We would get the review, no review decision in advance. We can do this confidentially, which is helpful. So we're not signaling to the marketplace that this is coming. But once we're ready to transact off of the data, we need to make sure that that registration statement's effective, and we need to have that, public in advance. And so that could signal market timelines. So a Wixie registration statement would allow us to react to the clinical data in that instance and do a deal, within a very much shorter period of time. and I think would allow those companies to fund. And sometimes we fund, sometimes we don't, but having the option to fund quickly for those companies is critical, and having access to capital for those companies is critical. Being able to pivot on information very quickly, and it doesn't necessarily need to be life sciences, but opportunities could arise for any public company. And if they weren't otherwise prepared to issue securities, they're going to miss out on a capital raising window due to just how this process works, not due to incremental regulatory oversight in the process. And so having access to that, the quicker path to registration, I think could be beneficial. As it relates to an ATM is an at-the-market program, and those are issued off of shelf registration statements. Those are useful tools. They allow companies to continuously access the market at market prices. And they sort of, the way I think about it is dribbling equity securities out into the market on a continuous basis under a pre-specified ATM program. And a lot of companies are using those as well. But the ability to raise meaningful capital under those, it depends on the trading volume of the company. And whether or not there's meaningful trading volume to tap into.
So that's a great dovetail into my question is going to be, so I think these are great discussions, speed to market, the ability to kind of go out there, sell to the capital markets instantaneously, take advantage of market timing. But at some point, like where's the bottom end of that range? Because a lot of the purview of this committee is the small cap companies. You're talking about companies with less than $250 million market cap at some point. Like at what point does that factor start to matter more than speed to market, where when you're talking about companies and you're advising them and you're saying, all right, capital markets just aren't ready for you yet because is there a threshold where they're too small? Where does that dynamic start to come into play?
It frankly comes down to the gatekeepers, and the gatekeepers are largely underwriters and research analyst coverage. I mean, you can find underwriters that will take you out at smaller numbers, but will you get the adequate research coverage you want to support you in the aftermarket? And so there are firms that will take companies out public for $25 million or so, I'd imagine. I don't see that very often. I mean, I alluded to the one conversation I had about, maybe you should just go access the private capital markets before the public, because the compliance cost of going public for a $20 million raise, it doesn't it's not a great use of proceeds.
Just pull on that thread. Is that largely driven by the compliance burden, or are there other downstream items on the exchanges, the market makers, or is the threshold there really just the compliance cost associated with it?
No, it's not that. I mean, the compliance, it's just from a use of proceeds. I don't love the use of proceeds if you're going to spend $1 million to go public. And you're raising 10%, then you're paying underwriters another 7%, and then there's other terms associated with it. A lot of money is going to a lot of people that aren't adding, going back into the company for use. I think that needs to be, that number is relatively fixed. I'm sure there are ways you can be more efficient with, counting and legal fees and other, implementation fees, but it's pretty much there, and it's not a great use of proceeds. In terms of the market, the NASDAQ has various tiers, and I think those tiers could accommodate sort of a lower market cap company. I don't think that would be it. The ongoing compliance is certainly a factor. But for those companies, why aren't you raising that capital privately? And sometimes it's because they can't. And that can be a bit of a red flag as well. So it depends situation by situation. It's not, for me, I think there is a size where it's just the costs associated with it are too high. Call that $10, $20 million. I think that might be around where it just doesn't make sense to be public. $50 million and above, sure. I think there's an argument around that. That would be probably, within the $50 million, assuming 20%, your $250 million market cap. Makes sense. Beneath 250 million, sure, but I think it gets a little bit more challenging from a cost and compliance perspective. Yeah, I think that would be my thought on it. I mean, I know there are IPOs that are done, lower than that, but that's where regulatory burden and overlay comes in, and it's advisors too, and it's the underwriters, and then it's the other things as well. But those smaller companies grow into big companies, and where I was saying the access to capital on a dime, that $150 $50 million market cap company could turn into a $300 million market cap company overnight, and they should be able to access the markets to fund that growth. That's where I was going with that.
You didn't explicitly state it, but in all of these recommendations, one of the big burden buckets that we keep hearing is the cost. So is it inherent in your recommendations that a company going private could assume that the cost of going public will be reduced as well if we improve the velocity?
Yeah, there are certain things that I mentioned which would reduce the overall cost to the transaction, because one of the biggest drivers of cost in the transaction is time spent on the transaction. And the fewer iterations of a document or the fewer financial statements that need to be prepared as we go along, the cost would certainly be reduced in that regard. The ongoing compliance cost of being a public company, I know one of the proposals is to eliminate quarterly reporting or make that optional for companies. That would reduce cost. Some of the scaled disclosure that is being discussed, I think, could reduce complexity and therefore cost. But the cost of being a public company rarely comes up in my conversations with companies as to why being public might not be a good idea. I think at a certain level, people understand that there's a cost to being public, and at the sizes I've mentioned, they just understand that's a cost of doing business. Could we and should we try to make that less expensive for companies, less compliance burden, where it doesn't have a contrary effect on the public policy of protecting investors? Yes, we should. But it's not necessarily, in my experience, has been the deciding factor of, oh, maybe I should do another private round because going public is expensive. I think those companies need another private round because they want to get some more experience under their belt. They're trying to do some other things to position themselves when they go out to be public to be the best company they can be at that time and be set up for success. That's more often than not the deciding factor of another private round or an IPO, is putting themselves in the best position organizationally, operationally, to perform well as a public company. The cost doesn't come up. We hear companies complain. We hear companies complain about litigation, which I think is real. The cost is real, but they do it in a way that's like, yep, this is what it is. We're still going forward. So I think we should do what we can to reduce the compliance and cost burden on companies who seek to go public, but it's not necessarily the thing in my experience that's driving the decision between that private financing round or the public markets.
So Robert, I see you have a question, but I just want to pull on one of those threads real quick of time and cost and the Valentine's Day cutoff that we were talking about. When you miss these windows, it is not an incremental increase to time and cost. It is significant when we have companies that have missed multiple windows, and now we're talking about effectively redoing, re-updating registration statements throughout a year, maybe an 18-month process. That is very large dollars adding up very fast, right? If you can get these deals done faster with time certainty, the costs will come down. Robert?
I agree completely with that. My question's separate. What are your thoughts on changing the WIXI criteria?
The WIXI criteria to lower it. I do think we should reevaluate the WIXI criteria to lower it to something more in the range of $250 million market cap. I think that would be a big benefit. It would allow more certainty on timelines. That, coupled with reevaluating the 1 year of reporting to 6 months of reporting for shelf eligibility, I think could be a very meaningful difference, and give companies confidence going into an IPO that they will be able to access the capital markets quicker. In that, for high growth tech companies, once the lockup expires, if the business is formed, they're often doing additional offerings, either for secondary sales or for growth capital, and giving them the certainty that that window will be easy to access for them would be meaningful. So I would encourage revisiting the WIXI's threshold, lowering it to 250. I think it was part of the initial proposal. I think it was contemplated by the Jobs Act that would be reevaluated, and I think that could be a meaningful difference, especially if it's, pardon me? 700, yeah. So I think that is something I would strongly encourage people to evaluate.
Great. I just want to make sure nobody has a question online. So if you do, yell to us. In the meantime, I just wanted to understand a little bit better. You were talking about the 15-day to roadshow,
Yes.
and it was 21 days. And you're saying you'd like to eliminate it completely. What was why did we have it at 21 days before? Like, what was the spirit of this from the beginning? Do we know?
You want me to answer? My understanding is that it was to allow the public to see the registration statement, to read the registration statement, and to allow the media to comment on the registration statement, and through that process vet in an informal sense the offering. Prior to the Jobs Act, all S1s were publicly on file for forever, so people had plenty of time to look at them if they so chose to do so. One of the things the Jobs Act did, which is really significant and meaningful, is allow companies to file those registration statements confidentially. So they're not signaling their intent to go public until they're ready to do so. And once they're ready to do so, they file that registration statement publicly. And when that confidential submission paradigm came in, the idea was, well, we used to have this public filing, people could evaluate it. So let's maintain a bit of that. Let's make it 21 days so people, including the media, can review and comment on that registration statement and see if it brings anything up. And so that 21-day window was put into place, and you need to wait 21 days before you can commence your roadshow. So a solution for a company would be to say, well, I'm not sure when I want to do my roadshow. I'm going to file public earlier and just eliminate that. But there's competitive reasons, there's signaling reasons that a company wouldn't want to do that and be very nimble with the announcement of their intention to go public, because it would be embarrassing for the company to say we're thinking about going public and then all of a sudden not go public. So being able to only state your intention to file to go public when you're able to have certainty you're going to be able to do it is the goal. And so that option's really not a great option. So companies now, the transparency of having it open at the beginning for 21 days has now been shortened to 15. And as I said, I'm not sure that for it's serving the purpose of that public vetting. I do know that IPOs, when they file publicly, they get reported on. Does it take 15 days for those articles to hit? No, they happen pretty instantly. And there is a roadshow. Those roadshows on the shortest in these days are 4 days. So because there's a lot of this testing the waters and market checks with investors leading up to the IPO. So those roadshows can be 4 days. So most you would have 4 days, for that. But I think these articles are written, comments are coming out very quickly. So I don't think it needs to be 15. I'm provocatively suggesting 0, but it should certainly be something shorter than 15, because that 15-day window, a lot can change. It's actually 19 or longer, depending upon, because you have the 4 days of roadshow built in. So it's a lot of time that a company's subject to market risk in that IPO in the capital markets being volatile, that all of a sudden a deal that made sense when you file publicly no longer makes sense because the market, nothing to do with the company, but the market conditions deteriorated so much that they have to postpone their IPO. And that can happen. And so I would suggest eliminating that 15-day window or reducing it to something significantly shorter, so that you're reducing that time from publicly filing that IPO and pricing the deal.
Do you think 3 days would be a reasonable amount of time?
Better. Yeah, I think so. I mean, there's the market cycle. So sometimes when we think about insider trading with companies, we think about how long does it take for that information to be digested by the market. 2 days is kind of the window on a conservative basis, but if it's a company that's like well followed, well understood, and well anticipated, 3 days is too long because it's probably been talked about. But a 3-day window would certainly be better than 15. And most IPOs no IPO is priced on a Friday. So, you would build that into your calendar. So 3 days would be better, certainly better than 15.
I have a question on that because, right, if you have 3 days, you're going to price on a Thursday, or you can go on a Monday, right? Same calendar week. Is this something where offering size and company, you should tier it towards that. Because if we're thinking about when the Jobs Act came online back right in 2012, and then obviously shortened to 15 days, the dissemination of information has fundamentally changed, right? That landscape has just changed. But as you just mentioned, for those well-followed companies, that information is going to get out there in the market significantly faster than if we have a small cap coming online.
Yeah, I actually think the small caps would get zero attention in the press, whereas
Regardless of timing.
SpaceX is going,
Yeah.
people are going to, they've already dug through those filings and are looking for nuggets. So the larger the IPO, probably that window is more meaningful. For a company doing $125 million IPO, there's never, I mean, sure, the trade publications may pick up the fact that it's been published, but they're not going to comb through it as much as some of those mega IPOs, where I think people will go through that regulatory filing in great detail. So if there was a tiered approach, I would say maybe err on the side of longer for the mega IPOs and shorter for the others, which is maybe counterintuitive from its face, but that's where I just don't think much would be picked up on the smaller IPOs whatsoever. I don't love tiered approaches so much because they do complicate things and there's a lot to keep in our head. But I think if there was a tiered approach as it relates to that, I would argue longer for the bigger companies because they'll get more attention and more people will go through those filings with a more critical eye. I think the sub $200 million IPOs are going to get very little attention.
Anyone else have any questions? Go ahead.
If I may, something we haven't talked about here is the role of AI and the potential perhaps for AI to collapse the timing as well as the costs. Are you able to speak to that to any degree?
Yeah, it's I have yet to see it in the sense that you send an investor deck to a registration statement writer and it spits out a registration statement in a day. Forms of it exist. It's dangerous, right? Because will people read it? But I think it's helpful. It will speed things up. The production of the document is not the limiting item. If we needed to get something out the door in 3 days, we would get something out the door in 3 days. Using AI to make our lives better during that 3 days certainly will be good. But we do discuss it as lawyers for the company, lawyers with the banks themselves, and the company, the management team. There's a process for creating that disclosure. I think AI could be very useful in creating a good first draft for discussion and shorten the timeline a bit. But that's not where the meaningful cut in the timeline will happen. People involved in that working team to prepare for this IPO. It's funny. And one of the questions is what percentage of time does it take? Can be 100, depending on how quickly you want to get it done. People will get it done. I think AI is a tool for making that more effective. I think as it relates to ongoing reporting as a public company, I think there should be some benefits there in terms of, populating the forms that are required to be, we're required to disclose under, but we still need to make sure, because of one of the tenets of what makes us really the most attractive market is that people have transparency and confidence. And so, there is a process for reviewing that, getting that first draft with an AI tool. Yeah, very meaningful, will be helpful, but there's no substitute for us all reading and discussing and debating the disclosure and making sure it's adequate. That is not what causes the time gaps here, though. The time gaps here are more structural and just part of the process. But where I suggested, I think those are some of the areas where I think we can cut some of that timeline off.
I do think there's benefit for having people in the room, and it used to literally be people in the room, and now it happens to be virtual because it balances, the markets know that folks have actually considered, okay, here are the disclosure, here are the risks, how does it actually apply, right? There's still a lot of boilerplate in these documents, but how does it actually apply to this company? And how do we describe the business, right? You're doing two things, right? Here's the risk, here's the investor protection, but it's also getting people in a room. How do we sell this company? How do we describe this company? That, AI, yes, it's really good, but can it capture the essence of here's this innovation, here's why we actually want to bring this company to the public markets. And some of these conversations can be very fascinating when you get diverse opinions, because management may be, it's this, the banker, sometimes that junior banker at 1 a.m. comes up with an idea that you're like, that's a good way to describe it, that you're just not going to get yet with AI.
One of the questions, so just going back to some of the comparison between public markets and the private markets, I guess just as a hypothetical, if a company came to you and let's say they had a term sheet for a private deal to raise $50 million, what would the circumstances have to be where you would advise them to take a stronger look at going public to raise $50 million instead? Like I know it's apples and oranges, but like, given the cost of compliance of a public company, is it just always going to be better to stay private? Or is there any set of circumstances where you would say, oh, why don't you consider going public in this one?
50 million. So that's a hard one because.
Or seven, let's make it 100.
100 million. 100 million. I would then ask, any expertise this investor is bringing to bear. Because a lot of times the investors are a validation for the eventual IPO, and having a good investor in your cap table shows that that investor has done diligence on you, believes in you, and thinks you're a good prospect. And so that can be a branding event in and of itself. You could do that concurrent with an IPO. So you could have a private investment pricing concurrent with a public offering. And so we've done that, and that is one tool. The first question I guess I would ask is, what's your need for future liquidity? Will this 50 million take you X years or to next event? And what's your financing plan at that next event? And if that next event is short term, or if their liquidity needs are going to be large, 50 to 70 million doesn't imply that they're going to need future large liquidity needs, but I could be wrong there. I also don't know what their sort of total valuation is. Is that 50 million sort of a 5% investment in some sort of larger, all of those things would come into play. But at some point, the access to capital, the new investors that you can bring to the cap table through an IPO, those are the things that drive companies to go public. And so it's sort of weighted on the two sides of that. It's sort of how I'd start to think about it, but that would be a dialogue, and there can be many different paths as to how it goes, but those would be some of my initial questions.
So I'm sorry, just a quick comment. As I listen to the lawyers in the room, I'm reminded of a comment from my business partner who's a physician. And he said to me a couple of years ago, in life, you want a young doctor and an old lawyer, because the rules don't change that much, or they don't change as fast. I'm a huge AI, a proponent of AI. We've got 11 investments, and they're all in the artificial intelligence space. And, in my past life, I worked on nuclear medicine systems and cardiac cath lab systems. I can state with a fair amount of certainty that if I were to go back and work with nuclear medicine systems where we're looking at structures in the heart and other organs, artificial intelligence could do better than the algorithms we had back then. So I would ask my legal colleagues to keep your minds open as artificial intelligence evolves, and not asking you to jump in the pool yet. But just be prepared to stick your toe in the water from time to time to see the value of that. It's okay.
I did use the word yet, Herbert. I did at the end of my statement.
All right. Well, with that, we are going to break for lunch. Edwin, thank you so much. You had some very thoughtful, and clearly you know the space very well, suggestions for us. So we will definitely take those into consideration. So we will be returning at 1:30 Eastern time after a short lunch break, where we will hear from Chairman Commissioner Ueda when we come back. Thank you all. 1:30.